Did you know that the average retail investor actually underperforms the stock market by nearly 4% every single year? Over 20 years, this difference could mean the contrast between retiring comfortably and working an extra decade. Here's the hard truth. Most beginners fail at investing not because they're not smart or lazy, but due to the wrong mindset and lack of strategy. Studies show that the average investor earns significantly less than the very investments they put money into. While the S&P 500 might return 9 to 10% per year, everyday investors often only walk away with 5% or less. It's easy to be tempted by success stories, but the reality is filled with failures that don't make headlines. In this video, we'll explore essential topics like the psychology of investing and common beginner mistakes. You'll also learn about the invisible forces working against you, such as fees, inflation, and taxes. By the end, you'll understand why most beginners fail and how to ensure you're not one of them. You don't need to be a financial genius to succeed at investing. What you need is a solid foundation. Imagine learning to drive. You wouldn't jump into Formula One racing on your first day. Many beginners skip the basics and chase high-risk trades, only to wonder why they crash and burn. Investing isn't about speed, it's about direction and steadily building wealth. Treat the stock market as a long-term business partner to win more often than not. Let me share a quick story about a friend who started investing during the pandemic. Like millions of others, he saw how easy it was to buy and sell stocks and thought, why not? Everyone's making money. At first it worked. He bought Tesla and it doubled, then Bitcoin shot up and he felt he had cracked the code. Then came the crash. Tesla fell, Bitcoin tanked, and he panicked, selling at a loss. He swore off investing forever, but this story isn't unique. It's the rule, not the exception. Many beginners fall into the same trap, believing investing is merely about luck and timing instead of strategy and patience. If you think, I don't know where to start, or I'm worried I'll lose money, you're not alone. More importantly, you're not doomed to fail. We'll break down why most beginners struggle and how to flip the script. Stick around as we uncover the number one force causing new investors to self-sabotage. It's not the stock market. It's what's happening in your mind. So why do most beginners fail at investing? It's not about their ability to learn or desire to succeed. It's their own mindset. The biggest enemy of the investor isn't the market. It's the investor themselves. Your brain is wired to make investing feel uncomfortable, and understanding these traps is essential for success. If you boil investing psychology down, it centers on two emotions: fear and greed. Greed makes you chase the next hot stock, while fear drives you to sell at the worst possible time. Together, they create a cycle that can destroy wealth, where markets rise and fall fueled by these emotions. This cycle is known as the behavior gap, explaining why the average investor earns less than the investments they own. In the modern world, FOMO, or fear of missing out, grips many as social media and finance influencers showcase incredible opportunities. This stock is the next Amazon, they proclaim, enticing everyone to invest. FOMO leads beginners to dive into trends without true understanding, often too late to cash in. Reflect on the crypto boom of 2021 when millions jumped in as Bitcoin soared to $60,000, driven by the fear of missing out. Yet just 6 months later, Bitcoin plummeted below $30,000, serving as a powerful reminder. The lesson? By the time you hear about an opportunity, it often ceases to be one. Another psychological trap is overconfidence, where many believe they are smarter than average due to the Lake Wobegon effect. In investing, this leads to dangerous assumptions about outsmarting the market and predicting short-term moves. The harsh truth is that even seasoned professionals seldom beat the market. Yet beginners feel they've cracked the code. Our brains are wired for short-term results, as our ancestors focused on immediate survival needs. People revel in quick wins from meme stocks, while steady investments seem dull and tiresome. Yet Warren Buffett wisely stated that the stock market serves to transfer money from the impatient to the patient. Loss aversion is another quirk. Losing $100 feels almost twice as painful as gaining $100 feels pleasurable. This leads novices to cling to losing investments too long, convincing themselves they will eventually recover. Alternatively, they may sell winning investments too quickly, eager to lock in small gains. Both approaches ultimately undermine long-term returns. The gambler's mindset reveals a crucial distinction. Many beginners mistake gambling for investing. Investing involves placing money into assets with long-term potential, rooted in research and strategy. In contrast, gambling is characterized by short-term bets, relying on luck rather than strategy. The thrill of gambling can easily mimic the excitement of investing until reality sets in. Just like a casino, the market often wins in the end, leaving the unprepared at a loss. Fear and greed lure you to buy high and sell low, while FOMO instigates a chase after fleeting trends. Overconfidence leads to the false belief that you're smarter than you think, while short-term thinking breeds impatience. Loss aversion freezes you at crucial moments, leading to missed opportunities. Gambling disguises itself as investing, a psychological trap that many beginners fall into. Understanding these psychological traps helps explain why so many beginners falter before they ever really start. However, psychology is only half the story in the world of investing. In the next chapter, we will explore the practical mistakes beginners often encounter with their money. These mistakes can quietly erase years of progress if not recognized. Let's turn our focus to the big mistakes beginners make in their investment journey. Skipping the foundational steps of financial preparedness is one of the gravest errors new investors make. Imagine trying to invest without a financial base, like building tall walls without solid ground beneath. The first step is ensuring you have an emergency fund, enough to cover at least 3 to 6 months of living expenses. Preparedness shields you from having to liquidate investments in times of crisis. Limiting high-interest debt, especially credit card liabilities, is also crucial for novice investors. It's important to develop basic budgeting habits for consistent investing rather than relying on whims. Skipping these steps is akin to entering the pitch unprotected, a gamble that can lead to pain. Beginners love hot tips and hype, but too often they chase trends based solely on excitement. A friend says, "Buy this stock, it's going to explode," igniting a rush of optimism. The problem is, by the time you hear about it, the hype is usually already priced in. Take the dot-com bubble in the late 1990s, where everyone flocked to internet companies fueled by hype without focusing on profits. Most of those companies went bankrupt within a few years, with only a few survivors like Amazon. Look at the meme stocks of 2021. Some people made quick fortunes, but most beginners lost big. The lesson is simple. If your investment idea comes from hype instead of research, it's gambling, not investing. Another classic mistake is thinking you can predict short-term moves in the market. Here's the truth. Even the best professionals can't consistently time the market, yet beginners keep trying. JP Morgan revealed that missing just the 10 best market days can have your returns. Those best days often follow the worst days, making panic selling during a crash a costly mistake. The smarter move is time in the market rather than trying to time the market. Regular, consistent investing nearly always beats short-term guessing. With apps like Robinhood or Trading 212, buying and selling stocks is easier than ever, but this leads to dangerous overtrading. Beginners often believe that more trades mean more earnings, but research shows the opposite. Every trade incurs costs, even with commission-free platforms, often due to hidden fees. Frequent trading leads to emotional decisions, disrupting the benefits of long-term compounding. Sometimes the best investment strategy is simply doing nothing. Every investment carries risk, but beginners often misunderstand its true nature. The real risk lies in poor choices, like putting all your funds into one stock or investing on debt. Beginners often take on too much or too little risk, not understanding their own financial tolerance. A common rookie error is putting all your eggs in one basket, whether that's one stock or a sector. When that basket drops, everything breaks. Diversification serves as your financial insurance. Long-term diversification is the key to safeguarding your wealth. Ignoring fees, taxes, and inflation can lead to unexpected pitfalls for beginners in investing. A 1% annual management fee might seem insignificant, but over 30 years, it can consume nearly a third of your returns. Frequent selling can trigger capital gains taxes, nibbling away at your profits. If your investments don't outpace inflation, you risk losing your purchasing power. These silent killers might not make headlines, but they can quietly decimate your wealth over decades. Maintaining low costs and investing tax efficiently is crucial in safeguarding your financial future. The eighth mistake is investing without a plan, often leaving beginners adrift in a sea of choices. Beginners might dabble in various investments randomly, from crypto to hot stocks, lacking direction. A solid plan should answer critical questions, providing clarity on investment goals and risk tolerance. Recapping the biggest mistakes, we see they are all avoidable with awareness and education. Unfortunately, the financial system often seems designed to profit at your expense, alongside your errors. The investment industry has built-in incentives that may not align with your financial success. Understanding these hidden costs and challenges is essential to arm yourself against the system's biases. Active management versus passive investing presents a common misconception among beginners: the belief that hiring a professional fund manager guarantees better market performance. In reality, most actively managed funds fail to beat simple index funds over time. A long-term study reveals that over 15 years, more than 90% of actively managed funds underperform the S&P 500 due to higher fees and constant trading. The system is stacked against consistent outperformance, yet the industry continues to sell these products, profiting billions in fees. Now let's talk about taxes, as every buy and sell can trigger capital gains taxes, reducing your gains. Smart investors focus on after-tax returns, utilizing tax-efficient accounts and long-term strategies. However, inflation sneaks in as a silent wealth killer, eroding your money's purchasing power over time. Even a nominal return can be deceptive if inflation outpaces it, making you poorer in reality. Brokers and fund managers often prioritize excessive trading over your financial well-being, encouraging behaviors that lead to losses. The industry thrives on drama and fear, marketing star performers while neglecting the ones that fail. Ultimately, the system isn't designed for your financial freedom, but to profit from your behavior. To summarize, fees diminish your returns, active management often fails, taxes bite at gains, inflation erodes value, and the industry profits from your mistakes. This doesn't mean you can't succeed. It merely calls for a smarter approach that protects you from these unseen forces. In the next chapter, we'll explore the right mindset and principles for building wealth long-term. The right way to think about investing starts with recognizing the traps: fear, greed, chasing hype, high fees, all benefiting a system that profits from your mistakes. So how do you beat the odds and become part of the minority that actually succeeds at investing? The answer isn't complicated. It's about sticking to a simple strategy. Think long-term, because the first rule of successful investing is time, not timing. Markets rise and fall, but over decades, they show an upward trend, even during wars, recessions, and pandemics. The lesson is simple: stay invested long enough and the dips become temporary, while the upward trend becomes permanent. Warren Buffett's wisdom resonates. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Adopting a long-term mindset shifts your focus from quick wins to steadily building wealth over decades. Enter the power of compounding, described as the eighth wonder of the world. Imagine investing $5,000 at 8% growth. That initial amount grows dramatically over 30 years without any additional funds. If you keep contributing regularly, the numbers can become life-changing. The key insight is that time in the market is your best friend. The earlier you start, the more powerful compounding becomes. Beware, beginners often fail by delaying or pulling money out frequently. Finally, successful investing can be simple. It doesn't require picking the next Amazon or constant trading. Consider using broad, low-cost index funds or ETFs, making regular contributions, reinvesting dividends, and staying the course through ups and downs. It may sound boring, but boring works. This approach often beats most professional investors with far less stress. As Jack Bogle wisely said, "Don't look for the needle in the haystack, just buy the haystack." Principle number 4, dollar cost. Averaging addresses a common fear. What if I invest today and the market crashes tomorrow? With dollar cost averaging, you invest the same amount regularly instead of a lump sum all at once. This strategy means buying fewer shares when prices are high and more shares when prices are low. Over time, dollar cost averaging smooths the impact of market volatility, taking emotions out of the equation. Principle number 5. Diversify wisely is crucial, as putting all your eggs in one basket can lead to failure. Diversifying means spreading your investment across different companies, sectors, asset classes, and geographies. Diversification protects you from catastrophic losses, much like putting on a seatbelt in a car. Principle number 6. Automate your investing addresses the inconsistency that often leads beginners to fail. Set automatic contributions to your investment account right after payday to ensure consistency. Principle number 7. Manage your emotions. Successful investors know discipline beats emotion during market swings. The market rewards patience, not drama. Principle number 8. Focus on what you can control. Shift your mindset away from predicting the unpredictable. You can control how much you save, how often you invest, and your emotional discipline. Focus on these controllables for power and reduce stress, and leave the rest to time and compounding. The beginner's action plan begins with understanding why beginners often fail and what truly works. Step 1 is to build your safety net before investing any money. An emergency fund of at least 3 to 6 months of living expenses is essential. High-interest debt, especially from credit cards and payday loans, must be under control. Think of this step as your seatbelt. Without it, a bump in the road could derail your journey. Step 2 involves learning the basics to diminish the fear of investing. At a minimum, you should understand key concepts like what a stock is and how compounding works. A weekend of focused learning can build a solid foundation in finance. Step 3 encourages you to start simple, focusing on low-cost, broad index funds. Invest regularly and reinvest dividends to gain diversification across hundreds of companies. Step 4 is to automate your contributions to maintain consistency. Set up automatic transfers right after payday to make investing a habit. Step 5 advises you to diversify your portfolio as it grows, adding bonds and international stocks. Keep it simple at first. Complexity is optional, not required. Finally, Step 6 emphasizes the importance of staying the course amid market fluctuations. The action plan can be summed up: build your safety net, learn the basics, start simple, automate, diversify, and stay the course. The biggest mistake beginners make is believing they need to be experts. You don't need to predict the next big stock or time the market. You don't need to spend hours every day studying charts. What you do need is a simple plan and the discipline to stick to it. That's it. That's the secret. And if you do that, you'll not only avoid the fate of most beginners, you'll set yourself up for real, lasting financial freedom. Most beginners fail at investing, but now you know why, and more importantly, you know how to avoid it. Stay patient, stay consistent, and let time and compounding do the heavy lifting. Because in the end, investing isn't about getting rich quick. It's about building a future where money works for you, instead of you always working for money. This is information, not financial advice or recommendation. Do your own research and seek independent advice when required. Investing carries risks.